Hey guys, welcome to FAQ. We are answering questions for young investors. Today's question, where should a new investor begin?
The first thing a beginner investor should do is to open up a brokerage account.
First of all, make sure your personal finance is in order. So the number one rule of personal finance for me is pay off your credit card debts. So to even begin to think of becoming an investor, you have to actually become a saver first. So if you don't have your finances in order, don't even think about becoming an investor. So that's what you have to do first. Learn how to be a saver first, and then let investing sort of take care of itself.
If you have credit card debt, pay that shit off as soon as possible. If you have student loan debt, hopefully you took it out for a reason, and hopefully it is paying off for you. But I certainly encourage you to pay off your debt, especially if you feel like it's crippling you. You can't think about investing. You have to get rid of your debt first. But if you are paying, if you have a reasonable interest rate, 4 or 5% on your student loans, and you're able to pay that comfortably, and you're able to pay your bills, you're able to contribute $100 a month or whatever you can, the earlier you get started, the better off you'll be. You will thank yourself 50 years from now.
The first thing a beginning investor should do is ask themselves what they are investing for. Having a goal in mind, even if it's just to save a certain amount of money by a certain period of time, is a much better approach than just randomly making investments and not really thinking through when you want the money, what you might want to use it for, when you might be using it. I think it's essential to have some sort of a plan. The plan can get more complex later on.
Your first investment account option should always be your 401k. So if you have a 401k at work, especially if it gives you a match, that's free money. If you're turning that down, you're giving up a 100% return right off the bat. After that, if you want to open an IRA and take care of tax deferrals, that makes sense to me.
TD Ameritrade, Fidelity, Robinhood, which has commission-free trades for somebody with a small balance, that's probably the right place to start.
You should open your first investment account somewhere where you've heard of the name of it. I think that's, look, there are people that open up accounts at Robinhood because they want to do recreational trading, they want to have fun. That's something different. When you're thinking about a long-term investment plan and you're thinking about starting to invest for the future, I would say the main starting point should be, okay, this is a firm that it's got a brand name, it's been around a while, and I would assume that it's got somewhat reasonable trading costs, it's got somewhat of a reasonable amount of services. Let me start there. Fidelity, Charles Schwab, not to pick one or two, but these are the types of firms we should be established at the very beginning.
Something easy like any fund company like Vanguard, Charles Schwab, T. Rowe Price, Fidelity, one of those places, put it on autopilot and make it easy so it happens automatically. If you want to get into something more like a Tinder for investing, I guess, Robinhood makes sense. So if you want to pick some stocks and you don't want to just go into mutual funds and ETFs or index funds, use something like Robinhood. It's a really easy app. I've used it. The trades are free. But whatever you do, automate your investing first and then have fun later. So set aside a little bit of your money to have fun, to keep yourself honest, but open up those easy tax-deferred accounts for retirement, including 401k first, then maybe like a Roth IRA. And if you still want to have some fun, open up a brokerage account at something like Robinhood and go nuts.
So I think there's so much attention being paid to selecting funds, selecting stocks, when really the major consideration that a young investor should have is asset allocation. And so what fund you use to get you there, sure, you want to look for things that are simpler. You want to look for things that have a lower internal expense ratio, which you can find by reading the fund documents. But worrying about, I'm going to buy an international fund, I hope it's a good one, I think is the wrong thing to be concerned with at the very beginning.
So you just have a little bit of money. Where do you begin? How do you even begin to trade, to invest, to allocate your assets? Here's what I would say. It depends who I'm talking to. If I'm talking to somebody that wants nothing to do with finance, that has a few hundred or a few $1,000 and wants to begin investing their money and watching, and seeing it grow, that's very different than somebody who wants to actively be involved in learning about finance. For the first person, I would say a great place to start is Betterment or something like that. You can have your assets allocated automatically. You don't have to do anything. They give you a low-cost asset allocation. That is more than all that you need. Now, if you want to really get into it and start picking stocks and buying and selling ETFs, just get started. There are no books that you can read that will teach you what it feels like to win or lose money. And what is the right style for you? I don't know. I don't know who you are. Maybe you're a momentum investor. Maybe you're a value investor. I have no idea. And neither do you, and that's fine. So if you want to get into this stuff, start now.
The good thing about selecting stocks and funds is that no one has it all figured out. There is no perfect formula for it. I guess the first step would be figuring out your personality, because unfortunately, the type of investment strategy or philosophy you use is going to have a lot to do with what your personality is. So I'd say first, at a higher level, figure out what your philosophy is going to be, and then have your philosophy sort of trickle down to your strategy. And that's kind of the way that you can use to maybe make some choices from that philosophy, where you kind of filter out the stuff you don't want to do. So all that's left over is the stuff that you do want to do. The other choice is, do you want to pick funds or do you want to pick stocks? So I think the biggest choice right off the bat is always your asset allocation. So once you get that figured out, then you sort of move down to the next level of picking stocks and funds. And then you have to realize, do I want to put the time and effort in to be an actual stock picker, which is not easy? Or do I just want to make it easy, set it on autopilot, and give all my money to some fund firm with an index fund or an ETF and make it easy on myself? That's what I would say for most people. Other people need to scratch that itch and pick some stocks and pick some sectors and maybe some different ETFs that niche down a little bit more. That's fine. Have your fun money. But it really comes down to understanding what your personality is, and that comes from the 10,000-foot view of figuring out what your philosophy is before you can actually invest in those stocks and bonds. But the good thing is, the sexier thing to do is pick individual stocks, but the most important thing is asset allocation. So once you get your asset allocation set, it's hard to really mess it up by picking the wrong stocks and funds. But I think that's the big thing, is just get an asset allocation first, then trying to do no harm when you select those securities.
The most important thing is that you read a couple of books on investing, and you probably want to read books that have been written by authors that are aiming for either a beginner audience or an audience of people that want to read casually. I don't think textbooks are going to help.
Well, shameless plug, you should be reading my blog. You should be reading my colleagues. You should probably not be reading topical news. If it's stale tomorrow, it's probably not useful today.
My whole journey to becoming a better investor was I was kind of self-taught, and it happened through books. So I'd say read books, but not just about investing. Read books about history, read books about psychology. Try to find fields in other areas that you can use to better yourself as an investor, because those are the things that matter a lot more. The investing stuff, everyone kind of knows what to do at this certain point, but it's the psychology and behavior behind it. So if you can read books about that, that'll help you improve the sort of mindset about investing. That's going to help you a lot more than reading any book about which strategy to use or how to pick the best stocks.
So one of the books that I always recommend is called Simple Wealth, Inevitable Wealth. It was written by Nick Murray. Unfortunately, not available on Amazon, but you can get it at nickmurray.com. I think that that's a very good explainer for people to understand why they're investing in the first place. And it deals with things like the fact that stocks do better than bonds long term. The whole purpose of investing is to outrun inflation so that the dollars you earn today don't lose their purchasing power 10 or 20 years in the future. That's a really good place to start.
Your asset allocation should be whatever you decide it should be. Now, if you're a young person who has 30, 40, 50 years to invest, you should probably have more stocks than bonds, because stocks have a higher expected return. Now, you have to earn those returns. They are not promised. The market owes you nothing. They are earned the hard way. You're going to see your money get cut in half more than once. Deal with it, or if you don't want to deal with it, that's fine, but you're not going to get the upside that the market can offer you. So there is no pain, there's no gain without pain. How do you even begin to figure out the right stocks or the right funds or the right asset allocation? That is hard to answer, and it's an answer that only you can find, maybe eventually. It takes people years and years and years of trading, of investing, of trying this, of trying that. The only way to figure out what works is to figure out what doesn't work. And I can't tell you what doesn't work for you, because this is such a psychological exercise, and I don't know you, and you probably don't know you. And the only way to learn who you really are is to put money at risk. Now, caveat, don't be an idiot. Only risk what you are really able to lose. But the sooner you get started, the sooner you'll figure out what type of investor are you? And that's only a question that you can answer.
The good news about picking your own asset allocation is there's no perfect portfolio or perfect asset allocation for certain ages. it really depends on the situation and the person and the circumstances, and then sort of their mindset and their emotions and their behavior. I guess for young people, I mean, it's virtually impossible to take too much risk in your portfolio, meaning equity risk, because your biggest asset is time and human capital, and those two things are going to totally outweigh your financial capital at the start. So again, it's virtually impossible to take too much risk. The problem is volatility and risk and loss can trip you up if you use those things as triggers to make mistakes and jump in and out of the market. So really the biggest thing is understanding your time horizon when you're defining these things and what you can do with handling losses. But for young people, the biggest risk is running out of money. It's not seeing a short-term loss in your stock market holdings.
You know, people ask about asset allocation when they're first starting out. I think it's really important to keep this very simple. I don't think that young investors need fixed income in a portfolio at all. So if you're in your 20s, especially if you're investing in an account where you can't even access the money if you wanted to, like an IRA or a 401k, I don't think that young investors need to worry about stability of their principal. They don't have a lot of money invested anyway. So if it moves around a lot, it's not really going to affect their current lifestyle. So I would say 100% stocks for someone who's very young and knows that this money is not going to be pulled out in 5 years to do something with. And then just have this acceptance of, hey, I'm going to see huge swings in my portfolio. I'm going to see drawdowns. Another question that I get on this topic is how much should I keep in cash? Or how much of my salary should I be saving for an emergency? Yeah, cash is separate. Don't look at cash as part of your investment portfolio. Have cash in the bank, whether it's 2 months or 3 months salary. When you're young, you're prone to economic swings and people get laid off. People at the lowest end of the totem pole bear the brunt of that. So some cash is good. Don't consider that part of your investments. And people say, well, how much of my portfolio should be liquid in case of an emergency? You're 25 years old. You are the emergency. You're a disaster. You're not going to be able to help. You might save like $3,000 and, oh no, there's an emergency. The $3,000 isn't going to help you, okay? You're a total emergency, so forget about that. Make sure you have enough cash so that if you get laid off, you can live for a few months and pay your expenses while you look for a new job. Anything beyond that, it should be invested.